Hi, I'm Dr. Cheryl Dunn, and I'm here to provide an overview of accounting for operating assets. Companies have three types of operating assets. The first are tangible. These include things that have physical substance that are going to last longer than 1 year. Things like buildings, vehicles, furniture, and equipment. Companies also have intangible assets. These are not physical, or at least the physical aspect of them is not where the value is. They are going to last longer than 1 year. And these include things like patents, trademarks, copyrights, and goodwill. This is not an all-inclusive list. This is just a representative sample. So anything that gives the company some kind of a right to do something is going to be an intangible asset. Those that have physical substance, again, this is not a complete list, but these are things that the company has that have value to them that are going to last longer than a year. And then the third type of long-term asset they have is natural resources. Natural resources typically consist of some type of land from which value is removed. So these include things like forests, coal mines, oil wells, or oil deposits. Okay, so the company buys the land that these things are on, and then they take those things off of that land, thereby decreasing the value of that land. Those are called natural resources. Okay, with respect to all of these different types of assets that the company has, there's three different phases that we need to account for. And the first, if we kind of draw it out on a timeline here, initially we need to record the acquisition of these assets. And at the acquisition, we're going to need to determine what the cost is. Now, it seems like that shouldn't be hard, but sometimes we have things that make it harder than it would first appear. For example, we need to include all costs, not just the cost to buy it, but to buy it, get it to our location, and to prepare it for its intended use. Sometimes that could involve removing a building from some land that we bought if we're not using it for whatever that building was there for. It can include all kinds of different taxes or import fees. It can include the freight to get something to our location. So there's a setup cost. If we bought a computer, some computer equipment to form a computer network, then the actual cost of building the network would be part of preparing it for its intended use. We also have, if it is a basket purchase or a lump sum purchase where we have multiple assets that we're purchasing together as one package, we'll need to determine the separate costs of the different assets. But relatively, it's not that difficult to determine the acquisition cost. We just have to factor these things in. The second time point is really all the time between acquisition and disposal. So we're going to say while the asset is in operation, while we're actually using that asset for company purposes, in other words. And during while it's in operation, the key is that we need to allocate the cost of the asset over its life. If it's a tangible asset, we're going to call that cost allocation depreciation. If it's an intangible asset, we're going to call that cost allocation amortization. And if we have natural resources, we're going to call that cost allocation depletion. Okay? And then the other time phase that's important is at disposal. The disposal can be a sale. It can be just a retirement. We just stop using it and dispose of it, discard it. Or it can be an involuntary disposal, which is associated with some kind of a loss. For example, our building burns down in a fire. That would be an involuntary loss type of disposal. And so at disposal, we need to remove the asset from our records, and we need to recognize any proceeds that we got. And finally, we need to calculate any gain or loss on the disposal. So that's an overview of the accounting that we need to do for fixed assets.